Alright, so we're going to go over the daily overview. We're going to take a look at the cover portfolio performance, and we are in second place somehow and holding. And I think it has to do with the crypto being kind of wild in some ways to where it gives us a random gain and pushing us closer and closer to God tier status monthly gain. If we can get 60% monthly gain average and hold it, that would be pretty close to like God tier status, that you're really good. And I mean, we're not doing bad, and we're just gonna try to keep it that way. So that's the Covey portfolio performance. We're doing well. The equity curve is like smoothing out. That was kind of the hope, is that it would do that. And then if we were to incorporate timing solutions, we got a divergence of the hard cycles going up, and then the Q spectrum 2 going down. And I would like to think that at the end of this year, that the Q spectrum 2 in the short term is correct. I would like to think that maybe we go up a little bit, but then have a swing down. So an example of that would be maybe we come up into here, and then we get rejected, and we make a new lower low, and that would appease me if we ended up hitting here and getting rejected a little bit. I don't know. That doesn't sound about right. Like, this looks like a rising wedge. Anyways, I'm thinking this is a rising wedge, and it's gonna come up in here, get rejected, and break down. And specifically, end. It's gonna start developing, I guess, a trail. But I ultimately believe that we might close the week below here, because we've pretty much tested almost both sides, and then we just need to get a little top heavy here and getting rejected in again the fake out zone again, the bull trap, and then get dumped a little bit below this moving average channel low for the bear fake out or the bear trap. But that's the hope, is that I hold on to second place. We rally maybe on Wednesday, and then we come down maybe Thursday, Friday, something like that. I don't know exactly how it's gonna go, but the hope is that the institutions are long. We pump up into that breaker, that H4 breaker, um, the H4 breaker, the H4 breaker, that we pump into it. We get rejected off of it. It becomes a rising wedge, and we fall apart. And maybe we come down all the way down here. That would make sense. Or we get below the previous week low. Yeah, that makes sense. We would fall down here. I mean, in a perfect world, I can't predict all this stuff, but we could come close. Ninja portfolio performance summary. So Ninja, we only traded yesterday. This is Tuesday. Yeah, Monday was a day off, basically. I mean, we didn't make a huge leap in performance, but I mean, if we were to just highlight today, the 27th, we made $300 per account, roughly equating to 1,960 net. Gross loss is 0. Gross profit is 3,913. Oh, no. Gross loss. Okay, so gross loss was 1,953, gross profit was 3,913. So we had a wash in one on Tuesday. We had a wash and then some profit net, but about 1,960. So I think it started off really bad because I didn't have any good signals to go off of, but I had a hunch that support was picking up, and it did. And the pattern was just kind of weak, but eventually it started to play out to where the direction I was thinking it would go, which is the bias of the institutions was long. So from inception, we are currently at 71 grand. If we put it by graph, this was last week, the 23rd. We were at 69 grand, and then we jumped all the way to 71 grand. And the goal is just to keep it to where the equity curve is up and to the right, and doing that in the safest possible way. So that's the Ninja Portfolio Performance. Daily closing thoughts on the S&P 500. So keeping in mind that the institutions, for the most part, are long, and then we have a divergence. We have an upswing in the decennial and the 4-year and annual. Might as well just say the decennial and the annual. And we're supposed to be hitting some kind of peak this day or tomorrow. So maybe I don't know if this has the bands. There it is. This one's got the bands. Maybe we spike up and trend today, and we stop out the bears, and then once we stop out the bears, the institutions come in and break the rising wedge, and then come back. It breaks above, or it spikes above, and then we come down for a retest, or we just reclaim to the downside, and then that's the end of that. I mean, it would make sense because this MACD looks like it's about to cross up, but then once it crosses up and it crosses back down, the impulse would make it harder to hold it to the upside. But in order for the institutions to go short, the price has to go up. That's usually how it works. So the magnet is the H4 breaker and also the fair value gap. But my intention is either to take out this swing high on the H4 or the H12, and then once we take out that swing high, we can get close to the fair value gap. We either get rejected here or we get rejected at the breaker. And I honestly have no idea which one it is going to be, but in terms of just how this fib is set up, when I attached it from this swing low to this swing low, we get forecasted some levels, and it happens to be really close to that H4 breaker. So, in my opinion, I would like it and prefer it to go to the H4 breaker, just because it feels complete, whether it's from the fibs that I forecast out or if it's from the pitchfork that operates on fibs as well. It just this is the fake out 0.382 level, and it would come in perfectly into the New York session to where it matches, like, oh, yep, hitting the rejection zone, swing failure pattern. I don't know how it's going to work exactly, but that would be my ideal. So starting from here, we were to remove that. From a weekly standpoint, we're near support. We're underneath it a little bit, and then on a daily standpoint, we're a little bit under the weekly open. We've been having lower high closes and higher low closes on the day. So we can mark that out here specifically. Let's see. Oh, it's anything I mark on this is marking over there. But you can see here that this is pretty much the daily support. We're really close to it, and I mean we're right on it on the daily close, and it makes sense right now that you do not short into support. It could be a bear flag, who knows? But in terms of like institutional bias, it makes sense that, and also sort of like an untested area that creates an imbalance, or that's a magnet. With institutions being long and we have a magnet right above us, it makes sense to try to shoot for long, and we're near daily and weekly support. Like, that's kind of just the idea. And if we were to put in a swing failure pattern, which is, I think, what it already tried to do for the Bears, it's kind of a moot point now. Like, I think it tried to dump on the hourly and filling the gap, and it just couldn't. And it's trying to put in a bearish pattern, like a swing failure pattern, but it's holding, and that's the problem. It's holding, and it's making it difficult for it to go lower. It could still dump, but it has a higher chance of dumping by going up first. And if it goes up first, then it has a higher chance of dumping because it can collect people that have an interest of breaking even or selling that got in long whenever we got over the moving averages over here. So when there's a lot of bulls trapped in this candle, so if they took it into there, some of the bulls would jump ship, and that would be ideal. Versus here, no one is really interested in jumping ship right now. They'll just wait and hold on to their position. And we're coming to the close of the year. There's no real bad news, so that's the thing. But taking it from a market structure break standpoint, we're still facing bearish, but we're really close to that daily open and daily support and weekly support. So it makes sense that we're going to get back above it. And also from the standpoint of the pitchfork, it looks like we got back above the Fibonacci 0.382 level, the fake out level, and it's going to fake out those bears right there. And then moving on, oil, we're going to see where we're at with that. So oil is trying, it looks like we had a H4 breaker to the downside. It's a little hard to tell, but it looks like it's holding to go up. We've gotten rejected on the past week, and this week we've touched weekly resistance. So we're trying to figure out what's going to happen next. We got below the weekly open, and it doesn't look good if we continue to go down. It looks like it's saying that this daily H4 candle is the one that broke. So we're gonna wait and see just kind of what happens here. But this could be a swing failure pattern. Left shoulder roughly, deviation right shoulder. So I don't know. I would think it's ideal because I'm short on oil, but we're in a weekly breaker to the downside, and we got rejected from weekly resistance. And if we get continuation of the H4 breaker, it makes sense that we would go lower. Yep, end of story. Credit spreads. Credit spreads don't look that good. It closed on the day breaking support. So when the credit spreads go down but the market goes up, smart money, there's a deviation. deviation mean there's like a disagreement. And the thing is, we would favor siding with the smart money, and the smart money is credit spreads or the bonds, and it's basically foreshadowing the next move, which is down. And we looked at the timing solutions, and we're hoping that maybe this Wednesday we see some kind of conclusion of the institutions switching sides, going short, and that this move comes to be. And it's a little difficult just trying to discern when that's going to happen, but we like to think that within one day we're able to not only hit the highs to where of the filling the rising wedge, but the institution switching sides in one day, and that's possible. So it could be either Wednesday, Thursday, or Friday. Who knows? But I'm going to try and be there to catch that move. Now, this is just looking terrible, and now on a daily closing basis, we have a huge possibility of a huge fill going to weekly support, and that's HYGH. And then going to LQDH, the long-term corporate credit spreads, we're falling apart here too. On a weekly closing basis, the next support is there. And then if we were to do on the daily, we could even use the swing failure point, which is there for support. We would try to see if it holds this low right there, but it's already low, and we got a gap to fill right there. But yeah, like, that's no sync good. But yeah, we flipped support to resistance. Let's see. I mean, it's red, so it's good. And then this day, flipped. It didn't hold. It broke. But technically, we don't need to write that in. But it's saying that we're at support right now, according to the moving average channel, and we're waiting to see it break to the other side. HYGH, let's see what it says. We broke through support there. So that's the credit spreads. The main thing we want to see is a divergence where credit spreads are heading down, mainly just HYGH, and then the S&P 500 is moving up. And anytime that the S&P 500 is moving up, it's a really good chance to get a position for the short side. And then we're going to look at the currencies. I don't know if we're going to look at the dollar. It seems kind of, to me, the best things to look at is like the euro and the Japanese yen, because the euro represents kind of risk on, and Japanese yen represents risk off in terms of things that just really affect the U.S. The dollar affects us, but for the most part, I think it's the importance of what was going on with the dollar. It's now started to consolidate. I think the move it made, I don't know if it's, unless it breaks a new high, I think it's going to consolidate. And unless it breaks the new low, I think it's going to consolidate. So I don't think anything really important is going to come from the dollar. I think because the dollar mostly goes sideways, and if for anything to become significant, it needs to break the high and the low of of the month or something, or the quarter. So looking at the Japanese yen and the euro is first. The euro was testing weekly resistance. We're in this like no man's land. We've kind of retested on the week the euro, and we were noticing that we've been having lower high closes on the day, and now we're about to get back below the yearly open. If we were to get back below the yearly open, it makes it kind of questionable, like what's going to come next, because it's showing as resistance, and it could. We haven't yet retested these. I don't know, for a swing, tested to hold for strength. So this could top out and roll over. That's kind of just what I see. You know, we'll see. We'll see. And then when we look at the trend line put in from the highs here, it's showing that it's hitting resistance. So we don't want to buy into resistance. We want to buy into support, and then we want to short at resistance. And it looks like we're bearish on the H4 breaking standpoint on the euro currency, and we're getting swooped by the moving average channel here. As far as like fake outs, we're high above those traps, and then when it comes to the trap on the daily, we're far away from it. Now when we go to the Japanese yen is a little elusive right now. Just it's retesting pretty deep into the market structures that it broke, and I don't know, like it could retest all the way down to here, and so we have to kind of just monitor it. And currently we're looking for a market structure break to the upside. We haven't retested the breaker to the downside here. This breaker needs to be retested, so we're waiting on that. And then this breaker needs to be retested. So we have a nested breaker here. It's ping-ponging. So we have to kind of just wait and see what's going to happen next. I would like to see it retest here and then retest here and it fail for pushing it back down. But yeah, ultimately that's what I would like. With the Japanese yen coming down, it would give a chance for the U.S. market to go higher and would fulfill the institutional bias, and then give us a chance to go short. And once it kind of comes back up into the upper magnet, then yeah, of course, like we'll have a really good position for shorting the S&P 500, showing the risk off as the dominant bias. And then the VIX I feel like is like choppy right now, but for the most part it's bullish and it's just gonna consolidate. So this is kind of what I see with that. We're just pretty much going sideways, higher low, closes on the week, and this could be a doji week for the VIX, to where we'll be sitting pretty for the first week of the new year to spring up higher on the VIX. So that's pretty much my daily overview. Videos to come. Trade plan for Wednesday. It's a little late for that because it is Wednesday at 5 a.m. And then the Charles Schwab thematic portfolio review, or thematic portfolio robot revolution, taking 25 stocks down to 10 stocks. So we'll see just going forward what we're going to do with that. I've been putting off that portfolio just because there is a lot of effort that goes into that portfolio. And I'm studying for my exam currently, and also trying to keep up with these videos every day. I mean, I'm making this trade plan for Wednesday at 5 a.m. I'm a little behind on the ball, and it's just trying to keep up with the daily maintenance, whether it's taking care of myself with rest or with work, and then taking care of my relationships, of those significant to me, and my purpose and all that. It gets a little crowded as to what I prioritize, and then but all in all, it's okay, because this portfolio will not really become super needed until we have some really collapsing times. Like, I don't know, I don't see us coming to a huge collapse. We want something more than 20% drawdown We want like a 30 plus kind of nuke to where we would need this portfolio. Until we have more than a 20 plus drawdown, like a 30 plus nuke, then we don't really need this portfolio. And I don't suspect that happening until 2024, 2025. So I still have some time. If anything, this is the thing that I have the most time before needing to have it finished. And then we'll have a video for trade plan for Wednesday. So that's pretty much it. Thanks for watching.